So we're going to start out with the lease updates. This is the new lease definition. It's changed a little bit from how leases were previously defined. It's a contract or part of a contract that conveys the right to control the use of an identified property, plant, or equipment for a period of time in exchange for consideration or payment. How they're identifying an identified asset is the customer must have both the ability to direct the use of the assets, not only directing the use, but also deriving the benefits directly from the use of that asset. The economic benefit, specifically the lessee can benefit from the use of the asset, and the underlying asset is neither dependent or highly interrelated with other underlying assets of the contract. So for most of our clients, it's going to be equipment, leases, rent on branches, stuff like that. So control is easily defined. You're controlling the use of your property. You're controlling the use of the copier. The customer or the supplier has the right to direct how and for what purpose the asset is being used. You have the right to operate it without having to get approval from the supplier. And then the customer designs the asset in a way that predetermines how and what purpose the asset will be used throughout the period of use. So the biggest thing under lessee accounting is now all of your leases are off balance sheet. You have your deferred rent if you have any escalating or rent clauses or free monthly rent payments, something like that. But now all of your assets or all of your leases are going to go onto your balance sheet. So a lessee will recognize on the balance sheet the present value of lease payments as a lease liability and a right of use asset. And that right of use asset is going to represent the right to use that underlying asset for the lease term. So when you're measuring the assets and liabilities, lessee should exclude any optional period payments if you have a lease extension or something like that, unless you were reasonably certain that you were going to use that option to extend the lease. That's the only time you would include that in your right to use asset. So on the balance sheet, what you're going to do is lessees are going to record a right of use asset and a lease liability for all leases with a term greater than 1 year. On the flip side, lessors are going to record property, plant, and equipment for an operating lease or a lease receivable or sales type lease for a direct financing lease. So under both operating and capital leases, your initial amount that you're going to record on your balance sheet is going to be the same. You're going to book it at your present value of your future lease payments. But the depreciation pattern between an operating and a financing lease are going to be different depending on the classification. So what you're running through in future years is going to vary. So one other thing to consider, your new right of use assets will be subject to impairment testing. So companies are going to have to come up with a process for determining that impairment value. And it could be something as simple as you have a branch in a specific market and real estate is downturn. So you have to consider, am I overpaying for this use or this lease resulting in an impairment in your right of use assets? So operating lease, again, you're going to recognize an asset and a liability on the balance sheet initially measured at the present value of future lease payments. You're going to have recognition of a single lease cost calculated so the cost of the lease is allocated over the lease term on a straight line basis. And then on your cash flow statement, everything is going to go through your operating part of your cash flow statement, very similar to how it is now. Now, under a financing lease, same thing, you're going to have a recognition of an asset or liability on the balance sheet measured at present value of future payments. The difference is you're going to have interest expense related to the lease liability, and then you're going to have amortization of your asset. So part of that is going to go through financing outflows on your cash flow, and part of it is going to go through operating. So the definition of a financing lease, it's changed a little bit from how it was defined in the previous years or under the prior standards. The lease term, the old language that said 75% or more of the economic life has disappeared. It's just the majority of the economic life, or 90% of the present value of the lease payments. That 90% threshold has also disappeared. So determining the asset amount, contracts may contain both lease and non-lease components. Lessees need to evaluate what services they are receiving and then allocate that consideration to those components. So as an example, if you have a $1,000 lease payment and part of that payment is for property taxes, but you don't get any outside benefit from those property taxes, then that's going to be recorded as part of your right of use asset. But if you can take a portion of that monthly payment and determine that you are getting an outside benefit or a separate benefit, like if you had a maintenance contract, then that would not be part of your right of use asset. So the new lease accounting standards can have a pretty significant impact to your business. It could actually merit reassessing your lease buy decisions and trigger the need to consider if you have any debt covenant compliance issues related to bringing your leases onto the balance sheet. Again, most outstanding leases are going to come onto your balance sheet, so there's a significant amount of accounting for that and processes and systems of controls that are going to need to go into effect to bring that onto your balance sheet. It's going to be a bit more work than what companies are currently having to do now. And then the new asset recognized for operating leases will change the company's book to tax difference computations if you're a C Corp. So again, the effective date is going to be December 15, 2019 for privately held enterprises, and early application is permitted. So right now we're going to go into a polling question, and our polling question is going to be, how many of you guys out there use an external accounting software for your leases? All right, thank you. So right now we're going to go into financial instruments. And again, just to reiterate, we didn't touch on every single aspect of this standard change. We really tried to tailor it to the Richie May client base. So the financial instruments, revisions are to, first, the classification and measurement of investments in equity securities, and then the presentation of certain fair value changes for financial liabilities measured at fair value. So marketable debt securities, only marketable debt securities will be classified as trading, available for sale, or held to maturity and accounted for under current provisions. So marketable debt securities, nothing's going to change in relation to those three classifications. The biggest change is under marketable equity investments. So unless an equity investment qualifies for equity method of accounting, or if you have an investee that you're consolidating into your set of books, those don't apply under this. But if you have an equity method of investment that doesn't fall under those two categories, all changes in your fair value of equity securities are going to go through unrealized gains or losses on the income statement. So in the past, a lot of our clients would treat that as available for sale securities, and that would run through your other comprehensive income. That's no longer going to go through OCI. All of that is going to flow directly through your income statement. Equity investments without determinable fair value. If you don't have an equity investment that has a fair value that you can determine, the cost method is going to be eliminated. other than those needing specialized accounting, you'll be able to elect to record equity investments without determinable fair value at cost, less any impairment, and plus or minus any subsequent adjustments. And all of this is going to go through your income statement. All of this is going to take effect December 15th, 2019 for non-public companies, and this too, early adoption is allowed. So current expected credit losses, CECL. For our client base, the most significant impact, since most of our clients are loans held for sale under fair value, are going to be your loans held for investment and the loan indemnification reserve. So this is going to have somewhat of a significant change in how you determine an allowance against your mortgage loans held for investment and also your loan loss reserve. So right now, the current methodology for loan loss reserve is a current estimate of contractual cash flows not expected to be collected. It's basically your probable losses. So right now, you're allowed to delay recognition of credit losses until a qualified event occurs or loss becomes probable. So most of our client base looks at historical data to determine what their current loan loss reserve will be and their current repurchase request or indemnification request. So that's how we're coming up currently with that loan loss reserve. What's changing is under CECL, CECL wants us now to look at the entire life of the loan's losses. The entire life must be taken into consideration regardless of if a qualifying event occurs. So it's both probable and reasonably estimable. The provision under CECL is recorded immediately upon sale of loan. So you're booking that allowance immediately upon sale of loan based on your expected life of loan concept and any losses that you expect this loan to have over the entire life of the loan using reasonable and estimable forecast. So the measurement of CECL, expected credit losses are based on relevant information about past events, and that's very similar to how we're looking at loan losses now, including historical experience with similar assets. Expected credit losses are based on current conditions, but 3 is the thing that is changing the most. It's expected credit losses based on supportable forecasts that would affect future collectability. So those forecasts, there's a bit of subjectivity that goes into them because there's a lot of data and, predicting what's going to happen in the future. The allowances will be based on a variety of methodologies, either on an individual loan basis or a collective pool basis for loans with similar characteristics. There's discounted cash flow, loss rate, roll rate, probability of default, provision matrix, loss rate methodology. The losses, again, are measured over the contractual term of the loan, considering any estimated prepayments. There's just a lot of variables that are subjective that go into these forecasting, and I know there's a lot of outside providers right now that are providing forecasting models for clients that don't have the capability to come up with these forecasts internally. They have a lot of outside data that will help to determine what your loan loss reserve would be. So that's definitely something that I think our clients should consider using. So again, 2019 is a big year. That's when CECL is going to go into place for privately held enterprises. Once it goes into effect, changes are applied at a cumulative effect adjustment to the statement of financial position. So that'll be somewhat of a big change, I think, for people. This one's not too bad. The statement of cash flows starting December 15, 2018, and early adoption is permitted. Right now, your statement of cash flows is just cash and cash equivalents. What's going to change is your cash used in operating, investing, financing activities, the net cash inflows and outflows. We're going to add restricted cash to that. So it's going to be cash, cash equivalents, and restricted cash. That's going to be your new cash flow statement. So that's a little bit of a change, not too big of one. The last thing I'm going to talk about is hedge accounting. So for most of Richie May's clients, we treat our derivatives as freestanding derivatives, so we don't technically fall under hedge accounting. But just so you have an idea of the intent behind this exposure draft, the purpose of the guidance is for both financial and non-financial hedging relationships, the goals are to improve the alignment between hedge accounting and reporting into these risk management objectives, and really to simplify the hedge accounting for preparers. If it's finalized, it's going to significantly change what qualifies for hedge accounting, how it is documented, how hedge effectiveness is assessed and hedge ineffectiveness is measured, and how the hedging results are presented and disclosed in the financial statements. So again, this shouldn't have an impact to our client base, but this and the next PowerPoint kind of give you a detail of what they're trying to accomplish and dig into with this standard. So this is pretty much it for the auditing gap side of the updates. I'm going to turn it over to Caleb.
Thanks, Jennifer. Again, I guess just as a reminder, you feel free to shoot any questions in using the features available there on your screen. We'll try to get to some of those at the end of the presentation. As Chad mentioned, my name is Kalen Ritchie. I'm on the tax side here at Ritchie May, and also kind of out in the industry at several conferences. So if you see me out there, I think my picture is included on this. Feel free to stop me and say hi. All right, so from a tax perspective, the things that you need to be aware of and that may change after 12/31/16 in large part relate to an act that was signed into legislation by the current president. It's the PATH Act. We love acronyms in both the accounting world and the mortgage banking world. The PATH Act stands for, I love this, that's why I'm mentioning it, Protecting Americans from Tax Hikes Act. It's amazing what they're coming up with now. So the PATH Act is the source of a lot of what we're going to cover on the tax side. It covers a lot of due date changes for income tax returns, and also a lot of information returns that do apply to mortgage businesses. There are some employment tax and wage reporting issues that we're going to cover. They relate more to, there's nothing really in the PATH Act that changed those. I just want to cover some things we see a little more often in our client base, and some common mistakes and pitfalls. Then there's the PATH Act did set new expiration dates on a lot of what are kind of generally grouped up as tax breaks that just kept getting extended by this act and ones before it. Most of them got extended again by the PATH Act until 2019, and then the PATH Act also made some permanent to it, so Washington didn't have to keep going back and just offering more and more extensions. With that said, there are some to expire come 12/31/2016, and it remains to be seen whether the new president-elect will retroactively extend these things again. I know Congress is already adjourned for the year, so it will have to be in the new presidency that they extend anything that is set to expire. I want to cover stuff that most of you probably already aware of, but just want to mention it. The 1098 statements, I'm sure you're familiar with them. The first one that has these new boxes on them is the form year is 2016, so I want to mention that. And then some significant changes in the world of captive insurance. The PATH Act changed some, gave a little bit more leeway, so to speak, in the amount of premiums you can pay to a captive. which is a very nice tax, it's a tax advantageous position, but it also puts some new reporting requirements that, should you not comply, have very, very steep penalties. So to start out, just want to offer up my first poll question, just relating to the type of businesses that you are all working for, or managing, or running. All right, thank you for responding to that. Looks like I'm not going to be speaking to deaf ears here. There's some applicability to some of the changes going on to the group. I saw some of you responded that you do work for and operate in a partnership structure. That is one of the biggest changes we've seen in a while to the tax world. The due date for partnership Form 1065 is moving from the traditional April 15th deadline and what's thought of, around the country as tax day, back to March 15th to line up with S corporation due date. So you can see the IRS's intention making some of these changes, and Washington's intention was to kind of have similar entity types have similar due dates and try to more naturally write into law the natural flow of how tax returns should work. So flow throughs are due March 15th in effort to get K-1s issued to the eventual owners, who then can use those K-1s to file their personal tax returns by April 15th. As a practical matter, though, we don't believe this might actually have an adverse effect and not allow for more individual returns to be filed on time. It might actually extend more. These anticipated changes, they, like I said, create a lot more natural flow of the tax return filing deadlines and the timing of the K-1s, but as a practical matter, gravitate slightly towards the new deadlines. It's ultimately an issue of when a partnership, for instance, gets K-1s that it might have an interest in, or 1099s that it needs to report as income. The March 15th due date just does not translate perfectly into more tax returns getting done on time. In the mortgage industry specifically, a lot of those audits we see push up right up until the end of March. So again, it's all actually more of a practical matter than when the due dates are. One other important note I want to point out in this chart that you're seeing is the Form FinCEN 114. That's more commonly known as Foreign Bank Account Reporting, FBARs. Those have traditionally been due at the end of June with no extension. They're now due April 15th, and there is an extension available. That's really important because the failure to file on time penalty for those forms is very hefty. I think it's $20,000. There's also a number of changes to just informational returns, like I mentioned. Some of the more applicable ones to your businesses, of those you listening, are the informational returns that relate to reporting information to your employees so that they can file their own returns. This is clearly an effort of the IRS and Social Security Administration to move up the deadline so that a lot less fraud is committed in terms of identity theft. You probably heard several times about scams where people were filing fake tax returns, and it was because the IRS and Social Security Administration couldn't match up the the Social Security number is being used on fake tax returns and tie it directly to a 1099 or W-2 file. So they've moved these deadlines up. So now, if you file a 1099 MISC miscellaneous with an amount in box 7, which is the box called non-employee compensation, then the due date is January 31st to both the IRS and to the one that you have to be mailed to the recipient at that time as well, and that's whether you're filing electronically or via paper. Employee compensation on W-2s and W-3s, which is probably a little bit more common, is also due January 31st, whether or not filing electronically or by paper. I mentioned the electronic versus paper filing because in the past you've gotten at least a month longer if you're filing electronically. To give the IRS and SSA time to process paper filings. There's a bunch of extension changes as well in this area and in the income tax return area. Some of those details were listed on that front slide. And if you have any concern over that, definitely reach out to one of our professionals here on the tax side or myself. I'd be happy to walk through those in more detail with you. So I just wanted to mention some of the more prevalent employment tax and wage reporting issues that we see. A lot of times there are wages paid to employees that aren't really thought of as wages. It's certainly a hard concept to grasp a lot of times because you're running a business and you don't think that giving a non-cash prize or award to an employee necessitates compensation and including a value of that in somebody's W-2 or 1099. But the IRS is getting a little bit more interested in this area, and just wanted to mention some of the more common fringe benefits that are above the threshold of a de minimis fringe benefit that we see oftentimes in our client base not being reported correctly in wages. So they're listed there. Personal use of company-owned autos is fairly common. This goes for W-2 employees, as well as there should be some documentation done by any owners of the businesses out there that are using automobiles and expensing some of the cost through the company. If they're not W-2 employees and they're owners, there's different calculations, but I wanted to mention specifically if you have employees using company-owned automobiles, there's a lot of documentation that needs to be done to substantiate the business expense for that, and it does need to be the value that you are expensing does need to be reported as wages, at least on the tax side. Obviously, what that does is increases your withholding requirements, and if not at the max, it increases the requirement for the company to remit Social Security, Medicare, FICA, FUTA, SUTA, all those W-2 type taxes. We actually sent out, Richie May did, a recent email blast that had a lot more detail, especially in the area of personal use of automobiles and including it in wages. So please reach out to us again if that's of interest to you, and we can resend that. Another one up there, group term life insurance in excess of $50,000. That's pretty prevalent. Any social or country club dues, even if it's a corporate membership and you have certain employees using it, if the per employee amount or value of that membership exceeds the de minimis fringe benefit threshold, those amounts should be included in W-2s. And then I think perhaps the most common one, awards and prizes given to employees should be included as wages, and increase the amount in box 1, 3, and 5 of your W-2s. The IRS is getting interested, a little bit more interested in this area, because they can, as that bottom note denotes, they can backdate withholding to when for instance, if you gave a prize or award to an employee at the beginning of the year, however, you didn't catch up and report that in their W-2 wages until, say, the end of the year when you're evaluating whether everything's been included in the right tax year, they can actually go back and make you refile and change your quarterly withholding taxes all the way back to the beginning of the year and assess late fees and penalties. Most of these fringes are required to be reported in W-2s when paid. And as a practical matter, I guess the ones on the screen, the bottom two are the ones that need to be reported in W-2s as paid. The other two you can kind of catch up at year end without any risk of under-reporting on payroll taxes. All right, coming back to PATH Act, just want to cover some of the expiring tax breaks. These listed here are set to expire 12/31/2016. The list is very long of the provisions that are set to expire, but I just included a couple that might by chance be applicable to our client base. And those on the business side would be energy efficient commercial buildings, and why you might not directly own a building in the mortgage company. You might be paying payments to a related party. The owners of the company might also own the building. So if it's qualified for an energy efficient tax credit in the past, it may no longer get that tax break. Indian employment tax credit. There's also I believe a veterans employment tax credit. Those are, I believe, set to expire. Some things that might affect your clients, your borrowers, are listed there under individual. There's the exclusion for discharge of indebtedness on principal residence is set to expire. I think, in all likelihood, that will get extended again, and that occurs when you go through loss mitigation with a borrower, and the best exit from the relationship is just to discharge the debt. The borrower in that instance right now does not have to pick up the entire amount of discharge of indebtedness as income on their personal tax returns. So whether or not you want to update your clients or your borrowers, if that is the case and that happens, letting them know that they're going to have to pick up a whole heck of a lot more income if they go down that road in 2017 or later. And then treatment of PMI or MIP as deductible qualified residence interest. So that's certainly a huge one for the industry if you haven't heard it before. I do think that'll get extended as well, but the president-elect nobody knows what he's going to do. So the PATH Act also extended a bunch of the tax breaks beyond 2016. Some of the bigger ones are listed here. First-year bonus depreciation. This is on qualified fixed asset purchases, usually asset purchases that have tax useful lives of 15 years or less. The bonus depreciation is extended through 2019, and the percentages that apply per year are listed there. It'll remain at 50% for 2015 through 2017, and it slowly declines to 30% in 2019. As of now, in 2020, bonus goes away. The new markets tax credit is extended as well. I believe that is extended to 2019, and the work opportunity tax credit is extended. I believe you would know if these credits were applicable to your business. If not, definitely mark that down and reach out to us as well. And then here are some of the more permanent. Here are the permanent changes that the PATH Act put into law. The Section 179 deduction, which is another kind of tax break along the lines of purchasing fixed assets for your business, it's just the expensing of property purchases, personal property, and certain qualified real property. Usually the qualified real property fits in the bucket of leasehold improvements. Although they did change the definition of qualified leasehold improvements as well in the PATH Act. Not too much has changed though, nothing significant and nothing applicable that we can see. So the permanent 179 deduction will be $500,000 per year, and that's phased out dollar for dollar once your fixed asset purchases start to exceed $2 million. And actually, I believe that's a typo. I think it's actually $2,010,000 for this coming year, 2016 tax year, and it'll in the future steadily increase index for inflation. The separate $250,000 cap on qualified real property is completely repealed now. So if all you did was $500,000 of leasehold improvements to a building, in the past you would have only been able to expense $250,000 of that as this separate cap would kick in. Now that cap's gone away, and just all of your qualified property just fits under one umbrella of the $500,000 limit. The R&D credit was made permanent. That might be applicable to some of you, especially as you invest more and more in technology. If those conversations, again, haven't been had, please reach out to us. And the 5-year recognition period for built-in gains tax, it's when a built-in gains tax applies when a C Corp makes an S election. And then subsequent stock of the S Corp is sold within a 5-year period. There may be some built-in gains tax to be recognized. That recognition period used to be, I believe, 10 years you had to wait before you could sell your S Corp stock and avoid the built-in gains tax, but it is now permanently changed to 5 years. Real quickly, this is probably rehash for all of you, but would be remiss if I didn't mention the 1098 changes. Any borrowers, clients, customers of yours that pay more than $600 in mortgage interest during a tax year, you have a 1098 reporting requirement to issue to that borrower. I'm going to skip ahead a slide real quick just to show you the new statement if you haven't seen it already. So the changes come in box 2 is the first one. The outstanding principal as of the beginning of the year listed on the form is required. This is in efforts to allow borrowers to calculate whether they're phased out of the interest deduction. Box 3, you have to include the mortgage origination date. Box 8, the address of the property that secures the mortgage. Although you don't have to include that, I believe, if box 7 is marked yes, which just says the mailing address listed is the same as the property address. Then for properties without addresses, a description is required in box 9, and let me know if that's the case. Please feel free to reach out to me. I guess there's some instructions to this form that details what a box 9 description entails. All right, before I get into the captive stuff, just want to take a poll question to see if this is even applicable to our audience. So, quick poll question. All right, thank you for that. Again, luckily, this will be meaningful to some. I apologize if this is just, not useful at all, but just want to cover this real quick. This is definitely something we've taken an interest in. You'll be seeing an e-blast shortly from the tax department here at Richie May on the updates that the PATH Act made to captive insurance provisions, and then a recent IRS notice that just came out early in November, actually, that lays out significant penalties if you don't disclose the past, basically a couple of items that may have happened in the past 5 years with regard to the relationship between the captive insurance company and the insured. So very quickly, the basic principles of a captive insurance company is there are business risks out there, especially for mortgage banks with all the regulation and scrutiny from regulatory agencies that mortgage banks are under. There are a bunch of risks that either can't be insured by normal insurance providers, or the cost of it is just ridiculous and based on a estimate of how often claims would come in doesn't make sense. So it's actually a very old provision in the tax code that a company can pay premiums to a captive insurance company. Those premiums are deducted at the on the company's tax return, and then subsequently actually not includable in income on the captive insurance company side. So it's definitely a situation in the tax world that doesn't happen often. A deduction on one side and no income on the other, kind of having a cake and eating it too. So captive insurance companies can insure the company that they're receiving premiums for business risk like business interruption, typical risks, I guess, that just aren't thought of and covered by, if you just went out on the market to State Farm or whatever, to a common insurance carrier. So there are many, if you haven't been approached by a captive insurance provider in the past, we definitely have some recommendations. Again, just reach out. But they should be, if this does apply to you, they should have been letting you know about this stuff as well. The premium limitation goes up. So before you could pay premiums of $1.2 million a year to this captive insurance company, resulting in a deduction. Now you can go all the way up to $2.2 million. It's a way of a lot of people also use this to build wealth with their capital outside of the mortgage industry. So with the increased benefit, there's also some new stipulations. And they're going to be relatively hard to meet, and certainly not the appetite that a lot of people had when they set these up. The risk diversification is going to have to be much more diverse, I guess. No more than 20% of premiums received by the captive may be derived from the insured business. So now you have a lot more spread between a huge captive insurance pool. You can't just insure your own business. Your captive is now insuring the risks of many other businesses participating in a similar format. also the ownership of the captive must mirror the ownership of the insured business. So if you're making payments to a captive, you can't name your child as the owner of the captive and you as the owner of the, in this case, mortgage company, kind of shifting wealth to get it out of your estate, tax-free. They're onto that, and they're going to close that loophole. And then this is this slide covers kind of the big ticket item I wanted to cover on the captive insurance side. The attention should be drawn down to that bottom line. There's a penalty of $10,000 if the disclosures listed above and detailed above aren't completed and submitted by January 30th, 2017. This detail comes from the recent IRS notice. It's 2016-66. I can send that out as well if anybody's interested. But basically, the disclosures that are there on that slide have to be completed, or there's a substantial just failure, basically a failure to disclose penalty. It can get pretty serious. The details of the disclosures are actually much more than that. Didn't want to, type them out in paragraph form. It's just it would by the end of the presentation you're already probably falling asleep. So didn't want to lull you all the way to having your eyes closed. So please reach out if any of this concerns you and you're in one of those captive relationships. Again, your captive insurance provider should be reaching out to you about this as well and helping you make sure you make the right disclosures. With that, I think we're all wrapped up, and we can certainly look into any questions that have been submitted to this point and try to answer them for you. I guess if this is if your interest level is dropped off, if 50 minutes for CPE is reached, so feel free to exit the webinar. Oh, you can't. I'm sorry.
Stick around for the survey.
Oh yes, I'm sorry.
Yeah.
I'm going to actually turn it over to Chad to do the housekeeping here at the end.
All right. Thanks, Caleb and Jennifer. So go ahead. After this, we will be posting the presentation to our website, as well as emailing the slide decks to all the participants on the call. Please complete the survey at the end of this. It will pop up. This is required for you to get the certificate of completion for CPE. After this, we'll be sending those out. And that's really all we have. I hope everyone has a good holidays and a good rest of the day. And thank you for joining us.